Welcome to World Knowledge. Warren Buffett's index is warning investors about the current stock market fever as AI trends increase and the Fed expects to lower interest rates. Warren Buffett, who has accurately predicted major fluctuations in the financial market many times, recently made a remarkable comment on the risk of a financial bubble, warning that the market may be facing a major collapse. With a wealth of experience and success in investing, Buffett's warning is not just a prediction but also a signal reminding investors to be cautious about potential risks. FDI lowest in 30 years. Foreign investors leave. An Asian country is facing three dangers at the same time. Struggling to save the economy. FDI lowest in 10 years. Foreign businesses leave in frustration. What is happening to the world's fastest-growing Asian economy with ambitions to replace China? The tragedy of a 69-year-old real estate billionaire who had to sell off his shopping mall division to pay off debts. Assets evaporated by 985 trillion Vietnamese dongs. Japanese tragedy. Famous baby diaper manufacturer breaks 151-year tradition. Switches to making diapers for the elderly. In 2001, billionaire Warren Buffett told Fortune magazine about an index that this investor thought was the best way to measure whether the value of the stock market was good or not. Specifically, the index that people often call Buffett Index measures the total capitalization of the U.S. stock market compared to the size of the economy by taking the total value of all publicly traded stocks as measured by the Wilshire 5000 index and dividing it by the estimated GDP of the most recent quarter. We can see that this is an index to measure whether the value of the stock market is too high or low compared to the size of the economy. If stocks grow much faster than the economy, it is a sign of a speculative bubble that can burst at any time. On the contrary, if this index is too low, it is an opportunity for investors when the market is undervalued compared to the economy. According to Buffett, an index of 100% is balanced, and if it is at 70%, it is worth buying because the price is cheap. However, if this Buffett index is at 200%, it is extremely dangerous because investors are playing with fire. Currently, the Buffett index is at its highest level in nearly 2 years at nearly 190%. The last time this index was at a similar high was in 2022 when it reached 211% and the S&P 500 index fell 19% the following year. And the AI fever and the Fed. CNN news agency said that the current market boom is largely due to the artificial intelligence fever when investors flocked to technology stocks, pushing the prices of Microsoft, thanks to the success of ChatGPT, or Nvidia, AI chip manufacturer, to unprecedented highs. In addition, predictions that the U.S. Federal Reserve, Fed, will cut interest rates 3 times this year have also caused capital to flow into the stock market. However, some experts are extremely worried that the AI fever is just a bubble and that the Fed will cut interest rates is unlikely to happen in the context of inflation still within the government's expectations. Even 2 Fed officials told CNN that they are unlikely to cut interest rates this year. If you have watched the video up to here, please give the video a like button, and if this is your first time visiting the channel, please subscribe to support the channel. I will give you a heart. Thank you very much. The market has 2 bubbles. The AI fever and the expectation of the Fed to lower interest rates. Legendary investor John Hussman said when reminding people of the 2000 and 2008 crises, "I think we are starting a new bubble cycle." Former U.S. Treasury Secretary Larry Summers told Bloomberg News Agency. The S&P 500 index has now increased by more than 10% since January 2024 and has surpassed the 5.200-point threshold. which is the level predicted by Goldman Sachs for the end of this year. Many analysts now believe that the stock bubble could push prices up to 6,000 points by the end of this year. The true story of the I and Fed fever can be illustrated through the recent volatility of the global financial market. In 2023, the world witnessed a strong explosion of technology companies related to artificial intelligence, AI. Names like Microsoft and Nvidia stood out as bright stars. Thanks to the rapid development of AI applications such as ChatGPT. Many investors recognized the great potential of AI and did not hesitate to invest in these companies. The stock prices of Microsoft, Nvidia and other technology companies continued to skyrocket, reaching unprecedented highs. In that context, there was a young investor named David who invested in Nvidia in early 2023 when he saw the rise of artificial intelligence. David is not a financial expert, but he is passionate about technology and closely follows the advances in the field of AI. When he saw Nvidia's stock price rise to an unbelievable level thanks to the demand for AI chip production, David felt extremely lucky that he had made the right decision. However, as the market continued to be active, worrying signs began to appear. Some leading financial experts warned that this AI craze could be just a bubble. And if investors relied too much on this technology without looking at real economic factors, they could face great risks. In parallel, the U.S. Federal Reserve, Fed, was also a factor that made the market very unstable. Many investors hoped that the Fed would cut interest rates to support economic growth. Rumors that the Fed could cut interest rates 3 times this year have further increased market expectations. This has caused capital to continue to flow into stocks, increasing the value of technology stocks. However, signals from Fed officials themselves paint a different picture. 2 senior officials have said that interest rate cuts may not happen this year, as inflation remains high and needs to be controlled more closely. This has left David and many other investors feeling confused. David decided not to rely solely on his belief in AI but also to consider macroeconomic factors. Instead of risking keeping all of his Nvidia shares, he sold some to protect his capital, but continued to invest cautiously in technology companies. This reality clearly reflects the strong impact of both artificial intelligence and Fed policies on the stock market. David and many other investors have had to adjust their investment strategies to adapt to the constantly changing economy, and learn not to put all their hopes on a single sector. No exaggeration. According to CNN, the Buffett Index ignores the money businesses earn overseas and does not consider interest rates, thereby achieving a fair assessment of the market. However, Buffett himself admits that this index has its own limitations. Agreeing with this view, J.P. Morgan Chase CEO Jamie Dimon believes that although the market is growing too hot compared to the actual economic situation, this is not necessarily a bubble. Remember the stock fever when the internet first exploded? That was a bubble, but now this cannot be called a bubble, CEO Dimon said. However, Charles Schwab's chief strategist Kevin Gordon believes that the current market. Still, Charles Schwab chief strategist Kevin Gordon says the market is vulnerable to negative news, especially corporate earnings reports, with investors optimistic about the future. Bad news can have a big impact on the stock market. Warren Buffett, the most risk-averse investor on the planet, has avoided every major downturn for nearly 100 years, and has profited from every one. During the 2008 financial crisis, Buffett was prepared. holding cash and buying a bunch of high-quality assets when they hit rock bottom, reaping huge profits. Now, Warren Buffett, holding a large amount of money again. Does this signal a new downturn is coming? When everyone started to panic, an important data appeared, causing all investors to flee. That is, the U.S. non-agricultural data. Lesson 2. U.S. non-agricultural data. The U.S. has sent a signal about cutting interest rates, marking the beginning of this storm. On July 31st, the chairman of the U.S. Federal Reserve, Jerome Powell, publicly announced that interest rates may be cut in September. This news immediately alerted the global financial market, because everyone knows that raising interest rates in the U.S. means keeping money in the U.S. will bring more profits, while lowering interest rates will, on the contrary, reduce profits. Therefore, when hearing the news that the U.S. wants to cut interest rates, smart investors immediately think of taking profits at a high level, because if they do not withdraw in time, profits will decrease. Unfortunately, at this time, the U.S. also released another series of figures. The official U.S. non-agricultural data in July was a real disaster, with the number of new jobs only reaching 114,000, much lower than the forecast of 175,000. Meanwhile, this figure in June was about 206,000, almost halved, which shows that the actual employment situation is very bad. It can be inferred that the business activities of U.S. enterprises are deteriorating rapidly. The more worrying figure is the unemployment rate, at 4.3%, the highest in the past 3 years, which directly triggered the Somme rule, which economists have come up with, which says that if you take the average unemployment rate in the last 3 months and compare it with the average of the 3 lowest months in the past 12 months, if it is higher than 0.5%, then it means that the economy is in recession. The scary thing is that this rule has been verified through 11 economic recessions in the U.S. from 1950 to now. When this figure was announced, the U.S. stock market immediately plummeted, with more than 70% of stocks on the market falling in price. Among the 7 strongest companies of the U.S. stock market, called the Seven Sisters, there are 6 companies that are falling, of which Intel fell the most, with its stock price falling 26%. Recording the largest one-day drop the most in the past 40 years. The remarkable thing is that it has just begun, and investors understand that the U.S. economy is in trouble. If they do not quickly exit the market, they will not be able to react. Warren Buffett's super cash. The current economic situation in the U.S. is making even Warren Buffett worried. On August 3rd, Berkshire Hathaway announced its financial report for the second quarter of 2024, showing that Warren Buffett sold $75.5 billion worth of stocks in this quarter, of which the largest stock, Apple, he owns, was sold in half, down from 789 million shares in the first quarter to 400 million shares, equivalent to a decrease of nearly 50%. Do you believe that selling Apple shares is just to avoid taxes? As Warren Buffett said at the previous shareholder meeting, Warren Buffett once said that there are only 2 reasons to sell the stocks you hold. One is when the fundamentals of the company change radically, and 2, when a better investment opportunity is discovered. Obviously, Apple's fundamentals have not changed significantly, so the second possibility is what we need to consider. So what is the better investment opportunity? U.S. non-farm payrolls and Warren Buffett reflect the volatile U.S. economy in 2024, forcing even seasoned investors like Warren Buffett to act quickly to preserve their assets. On July 31st, U.S. Federal Reserve Chairman Jerome Powell announced the possibility of a September interest rate cut, sending shockwaves through global financial markets. Investors understood that a rate cut would mean a decline in the return on holding money in the U.S., leading to a wave of profit-taking as they wanted to get their money out before the market could decline. Unfortunately, at the same time, U.S. non-farm payrolls data for July was released and sent shockwaves through the market. With only 114,000 new jobs, far below the forecast of 175,000. The figure showed that the U.S. employment situation was deteriorating. Compared to the figure 206,000 in June, the number of jobs fell by nearly half, showing that U.S. businesses are struggling. In addition, the unemployment rate reached 4.3%, the highest in the past 3 years, triggering the Somme rule, a clear signal that the economy is falling into recession. When investors realized that the U.S. economy was at risk of facing a recession, the U.S. stock market plunged. About 70% of stocks on the market fell sharply, of which Intel shares fell by 26% in one day, a record drop in the past 40 years. Investors understood that the economic storm was just beginning, and if they did not quickly exit the market, they would not be able to protect their assets in time. In that context, billionaire Warren Buffett was not out of the picture. On August 3, his company, Berkshire Hathaway, released its Q2 2024 financial report, showing that Buffett sold $75.5 billion worth of stocks during the quarter. Most notably, Apple stock, Buffett's largest investment, was nearly halved, from 789 million shares in Q1. Buffett now holds only 400 million shares, a decrease of nearly 50%. As we have seen, this has led many to question whether Buffett really sold Apple stock just to avoid taxes, as he has said. Based on Buffett's view, he only sells stocks in two cases: when the company's fundamentals change or when there is a better investment opportunity. With Apple, the company's fundamentals have not changed significantly. So the question is, what is the better investment opportunity that Buffett saw? This is not only a lesson in investment acumen and prudence, but also a testament to the challenges that even experienced investors like Warren Buffett face in times of economic uncertainty. Lesson 3. Japan raises interest rates. On July 31st, Japan announced an interest rate hike, raising the interest rate from 0.1% to 0.25%. This caused the U.S. stock market to collapse. And of course, the Japanese stock market was not immune to this collapse. Japan at this time is like a child who made a mistake. The Japanese Prime Minister, when going out, even has to be protected by 3 bulletproof glass panels to avoid being attacked. Japan is a special country. If the interest rate of the yen increases by just 0.1%, the shock may be even more serious than when the US increases interest rates by 5 times. Because, for a long time, Japan has become the free ATM machine for international investors. The negative interest rate policy, lasting 17 years, has made borrowing money from Japanese banks costless. When paying back the loan, you don't even need to pay interest. If you were a borrower, would you borrow money from Japan? Of course you would. This is the trading strategy, the most popular and successful. in the global financial industry. Over the past decade, which is yen interest rate differential trading, investors all over the world madly borrow yen from the Bank of Japan, then exchange it to other currencies, such as US dollars, to invest in the US stock market, or deposit money in US banks, to enjoy interest rates as high as 5%. Japan's interest rate hike on July 31, 2024, rocked global financial markets, causing the US and Japanese stock markets to crash. The decision seemed like a small adjustment, with interest rates rising from 0.1% to 0.25%. But the impact was much larger than expected. Japan has had a negative interest rate policy for 17 years, a unique strategy to stimulate the economy by turning the country into a free ATM for international investors. With extremely low interest rates, borrowing money from Japanese banks is not only cheap, but sometimes borrowers do not even have to pay interest. This makes Japan attractive to investors around the world, who borrow money in yen and then convert it into higher-yielding currencies, such as US dollars, to invest in US stock markets or deposit the money in US banks at interest rates as high as 5%. However, just a small increase in Japanese interest rates, from 0.1% to 0.25%, created a strong shock to the financial market. This not only caused the US stock market to collapse but also caused the Japanese market to fall into crisis. The economic situation became so tense that the Japanese Prime Minister had to be protected by bulletproof glass when going out, for fear of being attacked by people affected by economic fluctuations. The reason why the impact of the interest rate increase in Japan was greater than in the US was because Japan had long been a financial center for the yen carry trading strategy. International investors borrowed cheap yen and converted it into other currencies to invest, benefiting from the interest rate difference. But when Japan raised interest rates, the cost of borrowing became more expensive, causing the flow of loans from Japan to stagnate, shaking up global investments. Japan's decision to raise interest rates is not only a shock to investors, but also a reminder of the global economy's dependence on the fiscal policies of influential countries like Japan. Adjusting interest rates can create spillover effects, causing international financial markets to be unstable and investors to adjust their strategies to adapt to the new situation. Warren Buffett's warnings should not be ignored, especially in the context of the current volatile financial markets. The caution and long-term thinking he emphasizes are valuable lessons for any investor. If the bubble bursts, those who are not well prepared will face heavy losses. Therefore, listening and carefully considering investment strategies now can be the key to protecting assets and ensuring a solid financial future. If you find the video useful, please subscribe to the channel. Like and have any questions, please leave a comment below. Thank you for watching. Goodbye and see you in the next video.